Okay, great. I'm going to go ahead and play this video. Okay, so that was an overview of the geographic area where this project's located, and where you know, the overall New Albany market is, and expanding rapidly. It's growing very heavily now that Intel has announced their $20 billion microchip campus just about 9 miles from our site, and also in New Albany. And so that's one of the really exciting stories about this project, is this massive seismic investment that's going to happen with the Intel plant, and it's going to produce 10,000 jobs in the New Albany area. And so and a lot of those jobs will need to be filled by people from out of town. So we're anticipating a quite a large demand on our product, on our property. So it's, you know, like I said, very exciting for us. It's a very sexy deal because of that aspect of it. And that was actually the Intel announcement was a bonus for us. We were going under the PSA contract just as that announcement was being made, that they were going to be building that project there. So it's an added bonus. We already love this project and this deal, and the Intel announcement made it even more exciting. Side note on that, the construction on this project is going to be happening starting in October this year. So it's a fast track project that's aiming to address the overall global chip shortage that's going on right now. So as many of you know, we originally had this deal set up as a 7-year project, a 7-year hold, and we were offering a certain return based on that hold. We've actually restructured the deal, so now it's a 5-year hold, and we've changed the structure of the returns as well. So that was the primary goal of this webinar today, was to let everybody know about the changes in the structure and why this is even more exciting now for investors. We are recording this, so this will be available. We'll email links out. It'll be available after we're done here. So welcome to all of you that might be watching on a recording. So I'm going to go ahead and share my screen. Let me pull this up and then I'll share. And Chelsea Garber, one of my 2 great partners, she's going to help me present this deal, and we're not going to go through it quite as in depth as we have in the past. We mainly just want to hit on the changes in the structure and the returns, but we will do a general overview of the project as well. So let me go ahead and share this. Okay. So you all should see the title page to the PowerPoint presentation at this point with an aerial view of the property. We'll talk about the property in just a bit. For the first thing I want to do is talk about our team that is working on this project. We've got myself, the CEO, managing partner of Greenlight Equity Group. My two partners in Greenlight are Chelsea Garber and Carl York. And Chelsea is our director of acquisitions and performs quite a variety of other valuable functions in the company. And Carl is our COO and is really our tactician and handles a lot of the behind the scenes stuff. So you all will be dealing with Chelsea and Carl in addition to myself. We have on the meeting with us Tim Watkey, who is our sponsor on this deal. And Tim is a very experienced multifamily investor, has a portfolio of over 130 million right now. Excuse me, almost 1,000 units. So Tim has quite a large background in this asset class. We also have Mr. Alex Marsh with us of the Robert WEILER Group. Alex is our boots on the ground presence. He's going to be our asset manager along with us, and is really going to be providing high level expertise that he's derived from working in the commercial real estate market as a broker for the WEILER Group, and just brings quite a big skill set and a large variety of experience as well. So we're really excited to have Alex on board. We have two other partners on this project. Nail Benjamin he's a longtime real estate investor, and he is just very involved in a lot of different types of projects, ranging from vacant land to large scale mixed use projects. And then we have Mr. Matt Kontoff, who's also on the call with us. He has his own long skill set of real estate experience, and has basically started investing here in multifamily, and is invested in over 1,000 units in the multifamily space. So he's head of Red Wing Capital and is helping us out with this project as well. I'll just do a real quick overview of Columbus, just to remind everybody, if you've seen this before, that's great. If not, a couple of things to know about Columbus. It's a very shock resistant economy, and that's due to its job diversification and the economic diversification in Columbus. You've got the state, federal, and city governments there that are amongst the top 10 largest employers. The Ohio State University is the third largest school in the country, and those two institutions provide just a nice foundation for the overall economy there. In addition to those two spaces, we've got quite a bit of technology, manufacturing, retail. It's a center for a lot of retail and distribution, and it's really growing fast. It's a Midwest market that is increasing quite a bit in population. It's an incredibly popular place to live. Single family houses are few and far between these days and very expensive. So we love Columbus. We own 3 other properties there, and we shop there all the time. I'm from Ohio originally, so I have a good level of familiarity with the project, and with the overall market as well. and have a lot of ties there in Ohio. So we just love, we love investing there. I mentioned the Intel project before. It's a $20 billion capital investment that's creating 10,000 new jobs. This is going to really contribute to the overall tech market in Ohio in general. In fact, this plant is out in the middle of cornfields right now, and it's going to really create like a new city. There's already roads being widened, high-end retail, high-end restaurants and yoga studios. Target just got built out there. Starbucks coffee, all of the important retailers are setting up shop in and around New Albany, where we are. Yeah, so we're going to be, we'll get to this in a little bit, but we're going to be amongst the lowest cost housing in the area, which is going to put our rentals under quite a large demand factor. A little bit more about the Intel plant. This is a little map that shows you kind of where we are in relationship to the plant. We're about 9 miles away. And you can kind of see the overview here of the site where it's going to be built and a rendering of what it's going to look like. So it's a super exciting deal, super exciting prospect here of this infusion, and it's federally supported because of the global chip shortage. So it's really a fast track project that's going to provide a lot of jobs and a lot of economic infusion. In the New Albany rental market, I'll just hit on this one stat, which is that the year-over-year change in apartment rents was 12.7% last year. And it's projected again to be in the double digits this year. So the rent growth has already been quite stout there recently, in addition to the new jobs that will be created, and excuse me, and the economic infusion that's going to create even more demand. We're anticipating that our rents are going to grow at a very healthy rate. However, we have been pretty conservative in our underwriting as far as those projections go. We're not even close to this 12.7%, but we anticipate that, again, rents will do very well over the next 5 years in this market. I'm going to go ahead and skip a few of these slides here. This just talks more about Columbus. It's a very business-friendly state. Excuse me. There's no corporate income tax in the Columbus area, and it's within a 10-hour car ride of 46% of the country's population. So it's very well positioned, especially as a distribution hub and logistics hub. So some quick facts about Columbus: 14 Fortune 1000 headquarters and 5 Fortune 500 headquarters, including Nationwide Insurance, one of the largest employers in the city. And it's ranked very high with millennials. There's some really nice pockets of the city that are really hot and with younger folks that are growing fast. And there's quite a bit of 8th highest concentration of millennials in the US. Quick notes on demographics here. I want to just point out the average household income is in 2021 in this area is over 100,000. And again, one of the stats I haven't mentioned yet is that the gross median house price is over 750,000 in New Albany. So yeah, that's where we stand demographically. I'm going to hand the mic over here to Chelsea and let her cover some of the details of this particular investment.
Thanks, Tate, for the intro and kind of walking everybody through the summary of the property and why Columbus is so great. So here we're going to just kind of dive into opportunity overview as far as numbers are concerned. So purchase price is $9.3 million. We have 43 units, so that puts us at roughly $216,000 per door. We have an equity raise of about $3.6 million. We are doing a preferred return at 7%, meaning the first 7% from cash flow is preferred to our limited partners. So the limited partners get paid, after we've paid expenses, our debt service, we then have cash flow, and from that comes the preferred return, just to ensure that you get paid before, let's say, the general partners do. This is a 70-30 split. So 70% of the property or the entity is owned by the limited partners and 30% by the general partners. And the equity returned at sale will be your 100% of your initial investment, plus, of course, the other returns. So just to give you an idea on a return of a 5-year investment, the total return is 137%. Plus your initial 100%. So you're really looking at a 237% return. So closer to a 2.37x equity multiple. So that's, quite high, or at least from the deals that we do. One of the other key metrics that we look for is the IRR, which is the internal rate of return, at just shy of 21%. And the average annual return, 27%. So the average annual return would be, all your profits from cash flow throughout the 5 years, plus when we go to sell the property, from the proceeds from the sale get dispersed amongst both the limited partners and the general partners. So when you combine those two together, you get your average annual return. And then just on the right, I'm not going to go into it here, but just an example of what it would look like to invest $100,000. So over the course of 5 years, you'd get $136,000 back plus your initial investment. So just to be clear, that's again a $236,000 return. So a 2.36 or 2.37 equity multiple. We will be doing a cost segregation. So there will be depreciation and tax write-offs. That is still TBD, but that will be done in year 1. So as Tate has already mentioned, the property is in the city of Columbus, and the submarket is New Albany. A 43-unit brand new. It says C-class multifamily. This is in fact an A-class multifamily. It was built in 2021. We are purchasing the property directly from the developer. Our team had been in contact with him for about a year before we actually signed a contract. So we watched this property come to life, and it was just awesome to come see the attention to detail, and kind of really the owner truly poured his heart into it and didn't spare any expenses. The unit mix important here is 1 bedroom, 1 bath, along with 2 bedroom, 2 baths. And we have secured financing. We have a fixed 5-year rate, a loan at 4.25% with a 5-year extension. So if for some reason we decide, although we're planning to exit in year 5, if we decide we need to hold it a little bit longer, that extension is there. And as you all know, locking in a rate at 4.25% in this market is unheard of right now. However, this was a couple months ago, so we really kind of struck gold there. Property here, just going to kind of walk through the property itself. We're purchasing at a cap rate of 5.3%. Assets in Columbus, A-class assets, are trading in the mid 3s to low 4s. So right out the gate, this is substantially better than some of our other current comps. The occupancy is 91% occupied. So we currently have 4 vacant units that we've specifically asked the on-site manager to leave vacant, because we are planning to furnish them and do short-term rentals, or kind of like executive stays. As Tate mentioned, aside from the Intel chip factory, there's high demand for traveling nurses and other executives that are looking for furnished homes. There's not a ton of multifamily in the submarket. It's mostly single family. So this property is, already in demand. And then on top of that, we're going to charge a premium anywhere from $600 to $900 more per month in income for furnished units. And our new property manager, who is not the current property manager, has performed this at other properties. So that's something to note. We are definitely planning to get those furnished right out the gate and rented. A few photos of the interiors. As you can see, brand new designer grade kitchen, quartz waterfall counters, composite flooring that the builder has, is one of a kind from China that's literally bulletproof. So extremely low maintenance, soft close cabinetry, state-of-the-art appliances. In addition, he has, spared no expense as far as technology, video integrated, entry points, as well as unit doors. So high security, which, for our tenant base, which are going to be, working middle to upper class, young professionals. Technology is, of course, really important. Overall, clean, bright, modern, good bath mirrors, plumbing fixtures, and appliances. So what you would expect and more from a brand new property. Just another photo, hard to see here, but nice two-tone cabinetry, backsplash, very attractive units.
Class A finishes for sure.
Yeah. This aerial shot kind of paints a really nice picture of the property as far as location. So behind the property to the right, there's a grocery store, there's some retail shops, and then beyond that is a main road. So the property is just nestled kind of back off the main road, close enough that you can still walk or bike to places, obviously driving, but it's nice to be able to be in a community that is not on the main street. To the north side or northwest side, we have, as you can see, some pretty nice single family homes. And probably our greatest amenity space is this huge state park, which is full of, bike paths, walking paths. So we find that although our community does have some amenities which include a gym and meeting rooms, we also have a parked garage parking to the left here. You'll see there's two linear rows of parking garages with hookups for electric vehicles. So, this is more of a boutique experience where you're going to know your neighbors, you find a parking spot. And actually right behind the property, you might see kind of two blue umbrellas and a lighter brown roof. That's not part of our property. That's a daycare center. So just, very safe community. And again, really great location. The property is two buildings that are separated by a second floor kind of walkway corridor. You might not be able to see, I don't know, Tate, you could probably point to with the mouse, but in any event, yep, here's a better angle. So if you come in the main entry and you're using the gym or you're downstairs and the community room, you don't ever have to go outside to get back to your community. So yeah, just overall really, top of the line finishes and exterior, fixtures here.
I'll take this over Chelsea, this part. So the business plan here is it's basically not a value add in the sense that we are doing any construction or CapEx improvements. And this is due to it being a brand new building that we have under warranty. So it's very risk mitigated as far as the construction risk aspect of things go. The opportunity here is that the in-place rents that the property was leased up upon are significantly below market value to the tune of $200 to $300 per unit at least. And we are basically taking over the lease up right now. We're in the process of doing that. We're going to take the 4 remaining units that are not leased, we're going to actually furnish those and go for some shorter term leases that we have been told by our property management that they can expect, or we can expect about $600 to $900 more per unit per month, just based on them being furnished. So that's something we don't have in our underwriting as far as the upside potential on furnished units, but it is going to be an added bonus to this property. Our property management team, the WEILER Management Company, we'll talk about again towards the end of the presentation here shortly. And they are basically going to be handling this property. They have a lot of great experience in the market, and especially with this Class A type asset. We're going to be exiting this investment in 5 years. It still says 5 to 7. It's going to be a 5-year exit, pending market conditions, of course. So it's possible that we could get to our targets even sooner than 5 years. And if it makes sense to sell or refinance in 5 years and return capital and returns to our investors, we will do that in less than 5 years if possible. But we are modeling this as a 5-year investment at this point. This page is a breakdown of the pro forma numbers. I'm not going to get in the weeds with this with you guys today. We do have this available in our operating agreement as well, and our our offering memorandum that we are happy to get out. It's also in our investor portal, and so you can access this chart there. This is our cash flow projection, and this basically outlines all of the returns that are going to be going to our passive limited partners, and that might be you. So the overall metrics on the deal, the total deal internal rate of return is 25.43%. The return on investment, as Chelsea mentioned, is 137%, and the cash on cash is 9.4%. Moving on, just to re-highlight the returns based on a $100,000 investment. It's a 18.44% equity multiple. That average annual return is 26.09%, and the average cash on cash is at 8.5. So and then we mentioned the WEILER Management Group. They're going to be partnering with us on this. They have over 80 years of industry experience. They're a 3-generation company. Mr. Skip WEILER is the head honcho there, and owns quite a few of his own properties, and has 2 property management companies, this being one of them. So this is our contact information. I'm going to go, I want to just highlight a few things, and before we open up the mic to questions, comments, etc. But we've basically, like I said, for those of you that have seen this deal before, you'll notice that the structure is different. We increased the preferred return, and we also increased the equity split to the limited partners to a 70-30 split, and we decreased the hold time from 7 years to 5 years. So those are really the highlights that we wanted to cover today in the way of return metrics and basically changes that we've made to the structure. This is going to be very exciting. We're also on a quick timeline here. If you're interested in investing, our deadline for paperwork is going to be this coming Thursday, and then our wire deadline is Friday. We are closing this property next week on Friday, June 24th. If wires come in the first couple days of next week, that would be okay, though we are setting the wire deadline for Friday, this coming Friday, the 16th. So with that, I'll just open up the floor. I believe that we had Nail join us. Nail, I might put you on the spot here if that's okay with you, sir. Are you available to speak?
I will do my best.
Okay, appreciate that. Nail is on a family vacation right now, so he's joining us from California. And Nail, if you wouldn't mind, Nail came on board with us when he saw a presentation that we gave on this project. And I think it'd be great if you were able to kind of just share with the group, maybe just a high level overview of what's exciting to you about this project and you know, why you got involved.
Absolutely. And before I do that, Tate, can you tell me whether or not we were able to show either of our drone or aerial videos at the beginning of the webinar?
We were able to show the aerial video.
Okay.
Yep.
So I will say that outside of doing my paperwork homework, that is reviewing the underwriting, evaluating the submarket, getting a stronger appreciation for both New Albany and Columbus in general, and then also getting a better sense of what was happening economically, I took a trip out to the property, had an opportunity to tour the comps that are charging the market rents, to understand what those market rents look like and what those properties were asking for in terms of rent, as well as understanding what was happening in terms of the commercial growth, both institutional, corporate investment in the area. And I found it to be more than validating in terms of the paperwork homework that I had been doing. I believe that the aerial footage shows a decent picture of what I saw in person, but certainly coming to appreciate exactly what I'd experienced here in California, both in the major areas of Los Angeles and the Bay Area, and then some of the outside areas where, like we see in New Albany, high median household income, and appreciating what it looks like when large investors come in and put corporate facilities in the area, companies increase payroll that they're going to be paying to employees, and seeing that growth, it helped me to feel very comfortable with the upside of this investment and the reality of my position about the property being able to perform with respect to rents and being in high demand as a place for people to live, and ultimately for a new investor to buy at whatever point we decide to exit the property. So those were the main points for me that made me feel very confident in partnering with Greenlight on this deal.
Appreciate that, Nail. That's great. We're really excited to have Nail on the team with this property. He's brought a real high level of analysis and underwriting, and has made us feel even better about the deal as a result of his own independent research and work on the project. So we had a question from Matt Kontoff about the AAR hurdles, and what that's referring to is that this is a 70-30 split to the partners on the equity portion. So when the property is sold, the profits will be split 70-30 until a waterfall is met. So there'll be a threshold of 18% average annual return, at which point the split goes to a 50-50 split between the limited partners and the general partners. So that's an important thing to know. We still anticipate that this project, the whole project, is in the mid-20s as far as the overall deal IRR. So we will likely be exceeding that metric, and the split will adjust accordingly. So if anybody has any questions about that, we're happy to answer them. Or if anybody has any questions in general or comments or anything like that, we're here, more than happy to answer any questions.
Hey, just a quick question on that waterfall piece. I had an earlier deck presentation than what you showed today, you know, prior to your restructuring. It didn't talk about the waterfall, so I didn't have that detail. That was one of the questions I had. So you mentioned it flips to 50-50 at what number again?
Once the 18% average annual return is met.
Okay. And it's based on an average, not an IRR based waterfall.
Yeah, that's correct, sir. Yeah.
Okay.
And your prior deck didn't have the waterfall mentioned because our prior structure didn't have the waterfall in it.
Yeah, okay. Thank you.
Thank you. Anybody else have any questions or comments?
You just have one question for perhaps Chelsea about the loan. Is there any defeasance or prepayment penalties?
There are not.
Yeah.
There's no prepay. Yeah, like Chelsea said, it's a 5-year fixed rate at 4.25%. Another reason we're really excited about this deal is that interest rate. It does have a 5-year extension available where it gets repriced at 5 years, and then that's locked in for the next 5 years as well.
And what is that based on? The SOFR rate at that time or something?
Yes.
Okay.
Yep, exactly.
Cool.
So great. Any other questions?
Yeah, maybe another question along the lines of depreciation, and when you talk about, you know, a planned cost seg, is that expected that you'd have that done like before year's end and it'd show up on this K1?
Yes.
Okay.
Yeah, that's a great question. So there will be a cost seg study done. We're going to take bonus depreciation and distribute that to our limited partners proportionally. So there will be some really nice tax advantages. Thanks for bringing that up, Joe. Okay. Well, thank you all for being on this call with us, and thank you all that might be listening to the recording or watching the recording. We appreciate it. We are really excited to have you involved in the deal. Again, our deadline for filling out paperwork on the investor portal is Thursday, and we are asking for wires to be sent by Friday, if possible. First of the week would be acceptable as well on the wires. So with that, I'll just say thank you to everybody, and you know, we're here for any questions as on an ongoing basis. You can reach either Chelsea, myself, Carl, Nail, or Matt with any further questions. So thank you, everybody. Appreciate you being on.
Thank you.
Thank you.
All right.